and put. And we're gonna get there in about 3 classes. But before we get there, I want to introduce you to the idea, to the concept. Then we built on it. So today class is gonna be very simple, not about Black-Scholes, but I don't want you to think that the class is going to be how I'm introducing it today. Today I'm going to give you the foundation, but I want you to have the mindset that moving forward, you're going to keep building. Okay, you see the video about the farmer that he seeing uncertainty in the marketplace. And he is afraid that he may not be able to sell his coffee beans at the price he wants. So the farmer is faces uncertainty. You can share the slides with you. You don't really need to take notes here. Just follow the story. I'm gonna share this with you nicely typed and all that. And he wants to sell. So the farmer in Brazil wants to sell coffee beans because he's in the business of selling coffee beans. The guy who owns a coffee shop wants to buy coffee beans because let's say he wants to buy, so this guy wants to sell and this guy wants to buy. Why? Because he has uncertainty in the marketplace that the price may move. And if the price moves for this guy, he's not going to be able to give you the coffee for $4.50 every day. You want to have a peace of mind that his margin is there and he doesn't want to change the price every day or every month. So this guy wants to sell because he faces uncertainty, and this guy wants to buy because he faces uncertainty. Sell, buy. In the language of derivatives is short, long. So anytime you want to sell in the derivative language, you are short. Anytime you want to buy, you are long. Okay, so these two guys, two gentlemen, they find out that they have a mutual interest. If this guy wants to buy and this guy wants to sell, maybe they enter into an agreement that would help them achieve what they want to achieve. So this guy said, when will you harvest your coffee beans? When will you harvest? He said, in 3 months. So they wrote a contract. They start with a contract. In the contract, they say, within 3 months, this guy will buy from this guy. And in the derivative, this is going to be the maturity date. Or expiry. Okay, what else they wrote in the contract? They wrote in the contract how much amount they're going to buy. So they talked, and this guy said, I may have about 100 tons. So this guy said, great, I'm going to buy all your 100 metric tons. Okay, so this is in the derivative on the contract is the quantity. 100 metric tons, or TONNE, because it's 1,000 kilos. Okay, the price. Said, well, what is the price is going to be in 3 months from today? The price today for the coffee beans is the spot price. So today's price, what we call it? Spot price. With me, babe? So how much the coffee is selling today for is the spot price, the spot. But they're not buying today. They're buying in 3 months. So they said, well, we need to figure out a future price. How much the coffee beans is going to be in 3 months. And in the class, we're going to talk about how you price something like this in 3 months. But today, we're just going to assume. So they say, okay, well, the price is going to be $3,480 per ton. TONNE, because it's a metric ton. Hence, the price for the whole contract is going to be 3,480. 480, and we can add 3 zeros. I got too many zeros. 3,480. It's only 100. Yeah. So the total price is $348,000 for the contract. So this is the contract price. 100 ton, 3,480 per ton, assuming it was selling for 3,300 today. Okay, in the class, in the future, we're going to say how you price forward contract in the future, but we're not going to talk about it today. But they arrive to that price. So they say 3,400 per ton. The total price for the contract is 348,000. Okay, what else? They have to decide the quality of the beans. Is it Arabica beans or is it Robusta? Assuming this guy said, I grow Arabica beans, and this is the quality. There's a lot of things to the quality than what I just said. Okay, then they sign. They all signed both of them signed the contract. Okay. So far, we know there is a contract. 2 parties, they have mutual interest. One of them is short, the other one is long. They put a specific date, and we call it expiry or maturity date. They put a price, and this is the price for the contract, and they put a quality, and they sign. Now, once they sign, they both sign, this contract obligates them. They both become obligated to act on the contract. They both become obligated. They have obligation and they have rights. Each one of them have an obligation to act, and each one have a right to receive what they said they're going to receive. Also, we realize that this contract, while it gives the obligation, it's also customized. So, obligation, obligated, customized. Okay. 3 months in the future, there's 3 possible outcomes. The price per ton can remain the same as they agreed. 3,480 per ton. The total price for the contract, 348,000, right? This is the first possibility. In 3 months, for whatever reason, the price they expected, it's exactly what they signed for. We call this perfect hedge. Perfect hedge. Because each one of them has a risk. One want to get, and one want to buy, and one want to sell, and they achieve exactly what they want to achieve. We call this what? Perfect hedge. Most unlikely. So the price most likely is not going to become exactly what they agree to do. So 348, just gonna write it here, 348 cents. Other possibility that the price may go up in the future. So assume that the price now, instead of 348 per ton, let's say 3,500. I'm trying to stick to the information I wrote there, so you will have the same information. 3,500 per ton. So now the total price for the contract is going to be 350,000. The value, the future price now becomes the spot price, and this contract, the piece of paper they have, if the guy wants to really go on the marketplace and buy beans, it's going to cost them 350,000. Again, the story. They enter a contract in the future. They thought the coffee beans is going to be 348,000. Now the price of the coffee moved up. The piece of paper they have, the contract that guy have, is now increased in value by how much? $2,000. Because who's going to be happy? This guy is going to be happy. This guy is going to have a bigger smile. Why? Because he has a piece of paper that he can pay for 348,000, but it's worth in the market 350,000. Hence, he's $2,000 better off, right? Okay. The third possibility, the price goes down to 3,400. Hence, the contract is worth $340,000. Now, this guy is going to be extremely happy because this guy has a piece of paper that guarantees 348, and if he doesn't have it and he wants to sell his coffee, he's going to only walk away with 340. Hence, he is better off by $8,000. Here is better off by $1,000. You guys think so far? The story, right? Two sides, two people, two companies, two institutions. They want to hedge their risk. One want to buy and one want to sell. They enter an agreement to buy coffee in the future. In this case, is a farmer and a coffee shop owner, right? This guy is a coffee shop owner, and this guy is a farmer, right? Coffee shop owner, and this guy is a farmer. This is the Brazilian farmer that we saw in the picture. So they enter into a contract. In the future, three possible outcomes. But at the end of the day, one is going to be better off than the other. And this guy gained $8,000. It's exactly this guy lost. Because this guy can go to the marketplace and buy the coffee beans cheaper by $8,000. He can go and buy it for 340, but because of the contract, he has to give the farmer 348. In the first scenario, one guy $1,000 gain, it's exactly the other guy loss. So what do we call this? Zero sum game. Are you guys with me? Okay. What do you think? Is there any risk there? This is talking about $1,000 and $8,000. What happened is this contract for billions? It becomes bigger risk. What happened if the coffee beans, instead of the 348 or 340, it dropped to 300? Then it becomes 48,000. If this was in millions or billion, that's $48 million losses. Yes? You guys with me? I'm keeping this a story simple. In derivatives, we call this party. One guy on the transaction. This guy is a counterparty. Either one of them could be either or. So this guy is a counterparty risk. If the market moved too extreme and the other guy got to lose, he may renege on the contract. He may not pay or does not want to give the money he wants to give. Guys, we call this forward contract. And now we are introduced to the first type of derivatives. Forward contract. Now, what is derivatives? Derivatives is the contract on the future of the coffee beans. So derivatives is a contract. It's an instrument. Its value derived from an underlying asset or derived from an underlying element, because sometimes it's going to be an index. So what is the derivatives here? Derivatives is the contract. It's a forward contract. Its value is derived from the movement of the price of the underlying asset. In our story is the beans. So when the price of the beans goes up or down, the piece of contract Kevin have in his hand can increase or decrease on that. So what is the derivatives? It's an underlying. The derivatives is an instrument. It's a contract. Its value is derived from an underlying assets. One more time. Derivatives is an instrument. It's a contract. Its value is derived from an underlying asset. And it's not all the cases assets, but you could argue if it derives value, it becomes an asset. What I was just saying, an index is not an asset, right? It's an index. So the people in the derivative could say, but index is not an asset. The person who held it said, what's an asset to me? Because it's going to increase the value of that piece of paper I have, right? So you can argue it is an asset or not. But so a derivatives is a contract, it's an instrument, its value is derived from an underlying asset. So what is the underlying here? Is the beans. The underlying in the future could be Apple stocks when you have options. And oil, if you trade crude oil, right? So the underlying is the things that move the value of the piece of paper you have. You guys with me? Okay. Okay. Let's derivative language. The forward contract between a party and a counterparty. There may be a counterparty risk if one of them defaulted. The contract has to have an expiry date. It has to have quantity. It has to have quality. It has to have price. Okay. And what do we call this? Forward. Okay. Again, I can share. I try to memorize the numbers, maybe a little bit off here or there, but I think in the slides I'm going to give you, I'm hoping it's going to be these numbers. Okay. Now, what happened? A few people heard about this. And they said, well, it benefits everybody. So why don't we all do it? So now we have a bunch of farmers, a lot of them, and they all want to sell their coffee. And we have a lot of restaurant owners, and they want to buy. Few smart people like you, they said this seems like it's a business opportunity. But if we even go beyond coffee beans and get all the buyers that want to buy crude oils and all the sellers that want to sell crude oil, or the buyer that want to buy gold and all the buyers that want to sell gold. Want to buy beef, sell beef, right? And what we call these guys, the exchange, Chicago Mercantile Exchange. They say, what about one exchange? It's not one. What about if we get these guys together? We make a lot of money. So they said, okay, if we get all these guys together, we're going to make a lot of money. But what is the risk we can take? Because to get these guys together, they may encounter risk. Right? So we can get all the people who want to buy all the commodity in the world you can think of. Not everything is listed, but a lot of things are listed. And all the sellers, and we're going to be the middleman between them. So when you actually sell a contract, you're not going to know who's your counterparty is. I'm going to be the buyer for all the seller and the seller for all the buyers. One more time. The exchange is the middleman. He's acting as the buyer for all the sellers and the seller for all the buyers. While there is a counterparty on the other side, they will not know about each other. The exchange is in the middle. Chicago Mercantile, New York Stock Exchange, all these guys. But they said, you know what? There may be some risks. And they say the first risk is default. Default risk. What if this guy, he said he's going to buy, and he doesn't buy? Then I'm stuck between them, right? Default risk, right? Because the farmer and this guy, they know each other, they shake hands, right? And they can honor. There's a whole relationship between them. By the way, in the first contract, between the two farmers by themselves, we call it over the counter, OTC. When these two the farmer and the coffee shop just sign between themselves directly, we call this over the counter transaction, OTC, over the counter. It could be institutions, two banks, two companies, right? Mostly investment banks. Here is exchange traded. So they said, well, the default. What else? What other things, issues they may encounter? Well, she says you want to buy only 1,000 metric ton. He wants to sell 50. He wants to buy 75. So how are we gonna match these guys together? Oh, we're not gonna go into this headache. We're gonna have a fixed amount on each contract. So each contract is fixed to a specific amount. 1,000 barrels of crude oil. That's the contract. You buy one contract, two contracts, but there's no such thing as a contract and a half. So they have a fixed amount to each contract, right? In the previous story, they could customize their contract. Here, it's not customizable. Okay, so there's a default risk, and they have to fix amount. What else? What about if this guy wants to get it in 3 months? He only can produce in 6 months. He wants 4 months, 3 months. It's going to be a headache. So they say, you know what? We're going to have a fix and set expiry dates on every contract. So you can only exercise it in these specific dates. In March, in May, in July. You cannot come in the middle of the transaction and say, I want to exercise my contract. It have an expiry date, and it's set every 3 months, 4 months, and they give you the dates up front. Fixed expiry dates. Okay? What about if it's an item that you want to deliver? Set locations. They're going to have a set locations of the delivery. If you want to take a physical, now you know a new word, a physical delivery, you can pick it up from this specific location. We're not going to deliver it to your home. We're not We're not Ubers. That's 1,000 cattle. We're not gonna bring us out, you know, you pick it up from this place. Set location. And because of the default risk, how do you think if you are part of these people and you set in this venture, how can you overcome default risk? How can you overset default risk, guys?
Which word did you
Say again?
did you hear?
I'm sorry?
Did you call on me or?
No, anyone, let's go ahead. Go ahead, she raised her hand first.
For the cash up front.
Oh,
The two, like, the opposite party that's.
she's harsh. She said you gotta collect the money up front, the whole money up front. Well, they use a margin. Because if you have to collect everything up front, it's gonna create an obstacle. I don't wanna pay $348,000 from day one. I could invest this money for the next 3 months. Right? And there's another reason why they don't, and I'm gonna visit it. Hold the thought, that's a good thing. They did a margin. The margins in the derivatives market, guys, are completely different than the margin in the equity market. If you took my investment analysis class and I ask you on the test about the margin there, the margin here is different than the margin in investment analysis. Over there, you have to go 50%, 25% to maximize your purchasing power. Here, it's mark to market, exchange on a daily basis, and has a whole different story. And we're going to talk about it in the class. So you notice here that what is the difference between this and the other one? The other one was customizable. This is standard. Standardizing. Standardize. Right? Standardize the contract. First thing they do, they have a standardized contract. Second thing, these guys standardize the contract. Here, they set a margin. Before, there was no margin. Today, there is a little margin there in the OTC, but we'll talk about it when we get there. But in general, here, there is a margin, there is no margin. This is traded on the exchange. This is not traded, the first one is not traded on the exchange. What we call this? Futures contracts. This is the second type of derivatives. So we're building the foundation. Futures contracts are standardized. They have fixed amounts, fixed date to trade. What about the price? Is the price fixed? No. The price on these contracts is negotiable on the exchange. You guys with me? In the forward, there was a fixed price from day one, negotiated between the two parties. Here, it's on the exchange. But once you have it, executed that date, right? So the price is negotiable because there's a lot of traders in the market. What we call this, guys? Futures contracts. Okay. Now, let's assume, I'm taking this out here. So, these guys, the farmer, and the coffee shop owner, they know that there's different outcomes. The price may be up, down, rarely the same. So this guy said to this guy here, the coffee shop owner, said to this guy, I'm gonna enter a contract with you to do exactly what we agreed to do, but I want to have the right not to exercise the contract if I choose to. Let me repeat. This guy told this guy, I want to have the right to exercise. I want to have the right to exercise. So he said, if the price is not favorable to me, I don't want to buy the coffee beans. The farmer said, so why should I do that? What's in it for me? I mean, I'm into a forward contract with you for a sole purpose that you and I are obligated and stand by our contract. So this guy said, you know, I understand your point, and I'm thinking about a solution for you. And he kept thinking and he said, what about the contract that we entered in the past with 348,000? What about if I give you $20,000 or $10,000? What's $10,000? What about if I give you $10,000 today, and I have the right to exercise? What about if I give you $10,000? For the numbers, it sounds much, but let's bring it down 5,000. I'm going to give you 5,000 today, and I have the right to exercise. The 5,000 is yours to keep. Doesn't matter if I exercise or not. I'm going to give it to you. It's your money. If I want to exercise, I exercise. If I don't exercise, I don't want to, I don't have to exercise. The farmer thought about it and he said, you know what? I need money to cultivate and for my worker. Maybe it's a good idea. I'm going to give you a contract, same contract we have before, but this one will give you the right to exercise if and only if you choose. If and only if you choose. So this is a conditional contract. If and only if you choose. I'm not going to force you. The first contract, they both are obligated. In this contract, this guy is not obligated. He's going to give him $5,000 and he would exercise, it's up to him. When would you think the coffee beans owner would exercise? If the coffee price
Dropped so it wouldn't work, or rose so it wouldn't be favorable for it.
he's going to exercise if the coffee beans went so high up. Why? Because he's going to take it at the lower price from the farmer and sell it at the market price and make money. You guys with me? Say one more time. The owner, the coffee shop owner, give $5,000 to have the right to exercise. So let's say the contract was 348. In 3 months, the price of the coffee in the market, the spot market, is 360,000. That's going to tell the farmer, you're going to exercise. Sell me the coffee at 348. And he has two options. Either he use it or he sell it to someone else at 360. Then he makes money. You guys with me?
So the first guy, the shop owner gave him $5,000. Now, can that guy somehow default on the shop owner later on?
Yeah, but I'm going to tell you it's not going to happen. I'm explaining the idea. So stay with me. Thank you, Mike, but let's expand on it. Okay. Now, the shop owner, this guy, can do the same thing with this guy. I'm going to give you a $5,000. Okay, this first thing here is a call option. Now, I introduce you to what option is. An option is a contract, give one party the right, not the obligation. So Mike, options are traded on the exchange. Is not OTC. So he's not going to default because he's really facing the exchange. He's dealing with the exchange. For the example here, I'm just trying to drive the idea to you. Option is a traded contract and it's traded on the exchange. Okay? And this amount of 5,000 in the option language, you're gonna call it premium. He's gonna pay premium to have the right. So this guy is gonna have, he's gonna give $5,000, and the guy who's receiving, he's receiving a premium to have the right. Right? To have the right. Options contract or exchange traded contract, they not OTC, they trade between people, and you actually do not know who's the actual counterparty is. Because I said to you, the exchange is the middleman, it's a buyer for all the seller and seller for all the buyers. And you already pay a premium to have that right. Now, the farmer can say, I want to have the same thing. No. I'm gonna give you 5,000. And you buy from me if I choose to. Hence, he's gonna put it to him. We call this put. What we call it? Put. And we're gonna discuss calls and put options in length. I just want to drive the idea to you. And he's gonna do that only, Mike, in the opposite situation. If the price of the coffee beans now is at 320, and he has the contract to put it to him at 348. You get me? So the guy entered a contract and he said it's a 348, and this is gonna call it the exercise price. 348 is, in option language, the exercise price, and he's gonna put it, he's gonna shove it down his throat only if the price in the marketplace is a lot lower, right? Because it's gonna say, I can buy it from Gavin at 340, and I'm gonna put it to you at 348. And we can expand on these ideas, guys. I don't want you to just build in the momentum. What we call this? Put option. Okay. Put options are traded on the exchange. It is put, it is call. Okay. So now you got the idea about forward, you got the idea about futures, you got the idea about options. Fourth animal in the jungle, swaps. Now, these two guys, they've been doing business with each other for as the longest as this class started, 20 minutes ago. And they have such a good relationship, and there's a lot of trust between them, and they hang out together and they become wealthy from doing honest business with each other. Then one day while they are on the yacht, they open up to each other and they said, so what are you doing with all the money you've been making in the coffee business? So this guy told this guy, I have $100 million. And the other guy said, I have the same. How do you invest in that money? This guy said, I'm investing the money in a fixed income. And this guy said, I'm investing the money in a variable income asset. This guy is getting fixed. This guy is getting variable. One guy have a CD, the other guy have a TIPS, which is adjustable based on the treasury. Go up and down with inflation. And he said, okay, so you put your 100 million there. How much money is your 100 million making you? He said, well, on an annual basis, it's making me 70%. And he asked this guy, how much is it making you? He said, it's really the sulfur plus 2. it used to be the LIBOR, an index and a margin. An index and a margin. The margin is the 2%. The index is the SOFR. The LIBOR, there was a whole scheme around it, and is no longer as set as benchmark. Usually it's a SOFR. Okay, so this is an index. Sorry, this is an index, this is a margin, adjustable. Okay. So they said, well, it sounds, I wish I did what you did. And they both not happy with their wives. They want to change. So they said, what about the swaps? And the guy said, wives? And I said, no, no, no. Financial instruments. Guys, you're sleeping. Come on. Guys, what's laughing? So he said, no, we're going to swap financial instrument. We're going to swap the interest rate you are collecting. Interest rate swaps. IRS. But that's not the Internal Revenue Service. This is interest rate swaps. Okay? And one said, that sounds good. To swap whatever interest you collect. Because I want fixed, one of them want stability, one of them think he has higher potential to take the adjustable. They want to swap what they collected. They're not happy with it. Their financial situation is changed. There's other parameters. When we get to swaps, we're going to discuss it. I just want to drive the idea today. So this guy said, I have an even better thing. You and I knew each other. You have $100 million sitting in the bank, right? What about? I said, yeah.
Yeah,
Yeah. You want to give me something?
I wish.
You want to transfer it from my head to your bank?
Yeah.
That'll be good, right? So they said, what about that you take out your money out of the bank? I said, okay, sounds good, Freddie. Then I give you the interest you collect, and you give me the interest I collect, and you go ahead and you invest your $100 million in something else. Isn't that clever? So hold on. So you pay me whatever I collect, and I pay you whatever you collect, and we don't even have to keep the $100 million with the institutions we do? No. Why? Because we trust each other and we know each other. So swaps is a clever financial instrument. You don't have to give me the money. I don't have to take your money. We're just going to swap how much interest based on that. So what do you call the $100 million? The 100 million is the notional amount. Notional contract. The face value, the notional. It's not going to change hands. Take your money out. You don't have to give me 100 million. I don't have to give you 100 million. I'm only going to pay you on 100 million, but we don't have to pay each other. You with me so far? You don't have. Go ahead, take your 100 million out of the bank. I'm going to take my 100 million out of the bank. We're going to do whatever we want to do with it. And we're just going to assume that the notional value of the contract is 100 million. There is no 100 million exchange hands. What we call this? The notional value. You guys need to know that word. The notional amount. Okay? And for how long we're going to keep doing that? For 3 years. And that we already know, we're going to call it the expiry. We only can keep this for 3 years. After that, everyone does whatever they want. This guy, in the swaps language, is a leg. This guy is the second leg. Or this guy is a payer, because he's going to be paying the fixed to this guy, and this guy is the receiver. Okay? So each swap contract has 2 legs. in an interest rate swap, there's a payer and a receiver. And they said, okay, so what is the price? Since it's gonna be the 7%, that's gonna be the price of the fixed side. And this is the price of the contract. I said, okay, sounds good to me. When should we do that? Well, let's sign a contract. They sign, and they compound it to each other. $100 million notional value. 7% is the fixed price from the fixed payer. The receiver is going to receive 7%, and he's going to pay the other guy the adjuster. So for the first year, this guy supposed to give this guy 7 million. You guys with me? 7% of 100 million, that's 7 million in year one. And year two, he's going to have to give him also 7 million. On year three, he has to give him another 7 million. Fixed. And this has become the payer, this has become the receiver. In exchange of this guy has to give the SOFR plus 2%. What he was collecting. The SOFR plus 2%. The SOFR plus 2%. On year three. So this guy has to give this guy whatever the SOFR is plus 2%. The other guy has to give him the 7. Well, what is the SOFR? Well, that's the variable part. So today, or at the day one, when they signed the contract, the SOFR was 5%. You know, let's make it 6. That's how I put the numbers in your thing, but it doesn't matter. You guys can learn how to net it out anyway. So let's say the SOFR is 5 today, and 1 year from today, the SOFR is 4, and another year from today, I don't want to be 7 for 7. One of them has to have a little pain. So here is 4, here is 5, here is 6, here is 3. Okay? They don't move the extreme. I'm just using it to illustrate. 4, 6, 3. Keep in mind that this is today, next year, the following year. I'm not giving you year 3, so don't get confused, because this is a future rate that we do not know about it today. The only thing we know today, Kevin, is the SOFR today is the SOFR today is, I'm not sure what's happening there in the back, but the SOFR today is at cannot even say okay. Anyway, the SOFR today is the SOFR today is at 4%. We do not know what is the SOFR is. By the way, the actual rate is about 5.35 today. It's a 4% today. In the end of next year, 6. In the end of year 2, is 3. So there is always 1 day, 1 year lag, because we do not know this. We only know what's today, right? But here for the illustration, I'm already telling you because the time passes and you're figuring out. So here is what I said, 6 and 3. Okay? So you're not really looking for the third year rate, you're looking for the previous year. Because in the first year, you're paying today's rate. You guys with me? I'm giving it to you here, but in the reality, you don't know what is the structure going to be next year. The only thing you know today is at 4%. Okay. So this guy is supposed to pay this guy $7 million. This guy, how much is supposed to pay in the first year? So far is at 6 plus 2, how much? You guys with me or I'm losing you? Come on. No. This is a warm up. You guys with me? The guy supposed to pay how much say? 8. Why, Freddie?
Because sulfur plus 2.
Thank you. So far plus 2 is? So far is 4 and 2 is? 6. Is it that? Did I change it on you? Okay, so it's 4. 4 plus 2 is 6. Right? 4 plus 2 is 6. So this guy is supposed to pay this guy 6 million. This guy is supposed to pay this guy 7 million. Doesn't make sense. I'm not gonna give you 6 million with one hand, and you're gonna give me 7 million with one hand. So what they gonna do? They gonna net. So this guy would write a check for $1 million to this guy at the end of the year. You with me? This guy's supposed to pay him 7 million. He's supposed to pay him back 6 million. So they said, just write me a check for $1 million. What do you call this? In the future, in the swap, netting. On the derivative, they call this netting. Very important concept. Netting. You guys with me? They net out how much each supposed to pay. And now you with me or I'm confusing?
I
Okay.
understood the previous one's better than this one, not gonna lie, but
Okay, stay with me.
yes, sir.
Okay, so here, this guy received a variable rate, right? The variable rate, it has two components, an index and a margin. The margin is fixed, 2%. But what it changes the index, the SOFR, right? And the SOFR replaced the LIBOR. For the history, long time, the LIBOR, the London International Bank was the whole story, but there is a whole fraudulent story around it. So they replaced it with the SOFR in 2021.
Oh. I don't get the point. Like, if the leg 2 wants a fixed rate, why doesn't he just invest in a fixed rate?
See, this is, remember they were sitting on the yacht?
Yeah.
They have this already pre-exist, right? Right? And circumstances change. And you remember he was freezing $100 million to get the 7.
Yeah.
You got what I'm saying? And he's not happy with the 7. He wants the variable. So creative idea said, okay, you take your 100 million, assume if it's there, how much you're gonna make? 7. But you want the variable. And I have 100 million. I'm gonna do whatever I want to do with it, and we're not out. Because if he took his 100 million out of the fixed and put it in the variable, he's gonna make whatever the variable is.
Yeah.
There's more parameters to swaps. I'm trying to simplify it. Swaps, a lot of animals in the jungles. We're gonna get there. But for the time being, they want to swap what they have. Right? This is a simplified story. The real story is much more complex. We'll get there. They want to swap. Why? We're not investigating today. Why? We're investigating mechanics. You guys with me? We're investigating mechanics. But I want you to be mindful, it's still creative. You can take 100 million and do whatever you want to do with it. You with me?
Yeah.
Because if you put $100 million in the bank, it's in there. Now, the other guy said, I'm gonna give you whatever the 100 million you would give you in the variable market. And you give me whatever the $100 million will give you in the fixed market. Keep in mind, they're doing that to offset other hedges.
Yeah.
The moral of the story is more complex behind on the other side. One is limited to fixed and one is limited to variable. Usually those are banks, they're not a coffee guy and they're not a farmer. It's an institution to try to hedge other risks they have.
Got it. Thank you.
Okay, let's go back again. So here, 4 in the first year plus 2, that's 6. So this guy's supposed to write $6 million to this guy's supposed to write 7 million, so they net it out. Second year, it's 6 plus 2, it becomes 8. You guys with me? So this guy is gonna write now the check for 1 million. Because he's gonna get 7 from here, pay 8 from here, then he's the one has to write the check for 1 million. Again, I'm just giving you a number for illustration, guys, right? On the third year, the SOFR is 3% plus 2, that's 5. So this dude is gonna have to write a check to this guy for 2 million. What we call this? Interest rate swap. They swap in the net amount. You getting the idea about the net amount?
Yes.
Okay, you getting it? So they're only netting out how much they need to pay each other. Swaps are OTC derivatives. Only big boys, they play the game. Really big boys. It's not over-the-counter derivatives. In fact, the swap market is the biggest market in the world for currency swap and interest rate swap. Exchange rate risk. Okay. Any questions so far?
So they are OTC derivatives or they're
Yes,
not?
swaps are OTC derivatives.
Okay.
Okay, let me summarize what we talked about today. Now you have a lot of knowledge and conceptual framework about what derivatives are. You can sit in the coffee, having a coffee with your friends and tell them the story about derivatives. Can you do that? Can you guys do that? Yeah. Almost? Yes? I told you a story. It was a pure story, right? Okay, so the story, today's story is this. Derivatives. Are OTC derivatives, over-the-counter derivatives, and exchange traded derivatives. OTC, over-the-counter, exchange traded derivatives. Over-the-counter are forward and swaps. Exchange traded derivatives are futures and options. Options are later on classified into calls and puts. Swaps are currency swap, interest rate swap, credit default swaps, equity return swaps. That's what we're going to live for the whole semester. Now, derivatives, it's an instrument, it's a contract, its value is derived from an underlying assets. Over the counter is really institutional traded derivatives. Big boys play with each other with a lot of money. Exchange traded derivatives is the over the exchange. CME, Chicago Mercantile Exchange, New York Stock Exchange, Shanghai, whatever exchange you are trading with. These type of derivatives are customizable. You can customize it. Negotiable, you can negotiate its terms. It have a counterparty risk. It has a maturity and expiry date. It has a quantity. It has price, fixed price. This contract is traded on the exchange. You cannot customize it. It's standardized. You will need to pay a margin to the exchange to play the game. And we're going to talk about it. The Exchange Act as the buyer of all the sellers and the seller to all the buyers is the middleman. They have specific expiries, March, May, July. Different commodity has different expiry. They have fixed amount, 1,000 barrel. They have a specific location to deliver. These type of derivatives, either one of them, especially the future, it can be a physical delivery or cash net. You net just the cash amount, how much is going to be netted to cash. You don't take physical delivery of the actual commodity.
What the DERS stand for?
Equity return swaps. Options. Gonna dig deep into options, puts and calls. And options, you can do them on the equity, you can do them on the indexes. And options give you the right, not the obligation, to the holder of the option in exchange of a premium that will pay to the writer of the option. Swaps are currency swaps, dollar versus euro. Interest rate swaps, the example I give you. Credit default swaps, this is the one, in the words of Alan Greenspan, he found an issue there. But he was under pressure. Equity return swaps. Okay. I'm not sure if it was recorded here or was recorded in the share slides. Never, anyway, you will have it there. You think it was recorded in the slides or the shared
No, I
slides?
think it was recording
I think it
here.
was recording.
Okay. Well, hopefully you don't need to watch it again. I recorded just in case you want to watch it again.
But the screen is inverted.
Huh?
Like the picture, it's like backwards, like your right is to your left and your left is to your right. Like,
I think I can move that. Anyway, okay, so let me say it again. Forward contract, two parties, this is until 10:30, right? Two parties, one want to sell, one want to buy. The seller will call it short, the buyer will call it long. And the 3 months is the maturity or the expiry. The amount is 100 metric tons of coffee. That's the quantity. Future price. Keep in mind, the future price of a forward contract is going to be part of our discussion in this class. It was just given, right? And this is going to be the future in 3 months. The total price of the contract, 348,000, both signed agreement. This contract become obligated both party, and it's customized as you see. When the price change up and down, one of them is going to be better off than the other, and that may make you encounter counterparty risk. Here in the civil, if the price stay the same, I said to you that would be a perfect hedge, and it's unlikely. If the price increase to 3,500, the whole price of this contract become 350,000. So this guy is gonna be very happy because he's getting something worth 350,000 and he only had to pay for it 348,000. On the other hand, if the price drop to 3,400, 348, this guy is gonna be very happy because he was receiving 348,000 for something. If he decided to go on the marketplace and sell it, he's gonna sell it for 340. It's a zero-sum game. One party gain is the other party loss. And this is a derivatives. Its value is derived from the underlying assets. So you know what the word underlying assets mean? It's what you actually trading or what you actually buying or selling that give value to your contract. Your contract itself, its value is derived from an underlying asset. Are we good, guys? Any question? So what is a derivative? It's an instrument whose value is dependent on or is derived from, you can have all these slides, from an underlying variable. And I use the word variable because it could be an index, but someone will say, yes, it's an index, but if it can create value to me, it's an asset. It could be a commodity, stocks, interest rate, foreign exchange, or an index. And we're going to visit these. Here, I said to you, if you find an opportunity, and this was the exchange, they can be the middleman between these guys and these guys, and they might run into risk, default risk, quantity needed, time of delivery, location, and who has facilitated the trade. This I said to you, this is what they encounter in the risk model. Therefore, they need to have it customized. Standardized or customized, it would have a date to delivery. The maturity date or the expiry date is fixed. Depend on the contract type. It's not always March, it's not always May, just here for illustration. But when you buy a contract, you know when is the expiry date. It has a fixed amount. For the coffee, is the one contract is 3,500 pounds. You cannot buy or sell less than that in the future market. Fixed, right? That's the contract. As I said, in crude oil is 1,000 barrels. So each one has fixed. The location, New York District, Virginia, New Orleans, all these places, Barcelona. The price for these derivatives is not fixed. The price is discovered on the exchange based on the trade and the amount of the trade. So we have a fixed quality, quantity, physical location, and it's facilitated by the exchange. The exchange is the buyer for all the sellers and the seller for all the buyers. And the value of it is derived from the underlying assets, whatever you do in the oil. If the oil per barrel move up, your contract move up or down. By the way, while there is an expiry date in oil, that doesn't mean you cannot trade it. In fact, you can trade it anytime in between. You guys with me on this? This is a very important concept. Don't think when you have a future contract, you have to wait for the expiry to trade it. This is the maturity date, but it can be traded anytime. You still can offset your position anytime. If you have an options, you can close your position and sell the option anytime. You don't have to wait for the expiry. But again, how it's priced in between, we're going to talk about it also in the class. Now, I said to you what happened. We're ready. There's a counterparty risk default, and this is a problem. And the exchange set a margin requirement, and the margin is dynamic, and the margin is set every day. The margin actually settled, and it's marked to market. Mark to market. In other words, you need to know mark to market. And the margin here is completely different than the margin on the equity, and we're going to talk about it when we get there. Now, I told you what happened if one of them said, I want to have the option to not the obligation. They said, in this case, you'll have to pay for it, and this becomes the option premium, and the person who is receiving the premium has the obligation. The person who is paying the premium has the right. You with me? The person who is paying the premium has the right. can only act when he wants. The person who's receiving the premium has the obligation to act when he's asked to act. Right? What we call this options. And there's a premium and there is an expiry and options in every element. And there is a put and there is a call. Okay? So call, put, and we explain which one has the call. This guy, the long, he has the call if he has to pay for it, and he will only exercise if the price is higher than the exercise price, because it makes sense to him. The guy has the put, he will only exercise if the price is lower, because he's gonna shove it down the throat of the other guy. Okay, then we said there is another type after they hang out on the yacht and they start opening to each other, and they say, I'm receiving fixed income, I'm receiving variable income, and they say I'm freezing 100 million there and I'm freezing 100 million there, but we're institutions, we're big guys, we don't really have to freeze our money. We just can exchange as if the money is there, and we call this the notional value. What we call this, Kevin? And this is the biggest problem in derivatives. Someone, we'll get there when I get there, but you need to keep in mind of that. The notional value, extremely important concept. The notional value of how much they act as the money was there. But it's not there. That's an exchange hand. In fact, guys, the only thing exchange hand in this big transaction for 100 million is these trades. 1 million, 1 million, 2 million. Keep in mind, this number may be a little bit different than the number I show you on the board, because here I said 6% in the first year. So 6% plus 2, that's 8, because this guy has to write a check for $1 million. And on the second year was 4% plus 2, that's 6. He was supposed to write a check for 6 and get a 7. This guy write a check for $1 million. Here was 3 million plus 2, that's 5. So this guy give 5, this guy give 7, so we wrote a check for 2 million. We call this what? Netting. Gonna kill me there. So we already said what is the derivatives are, over the counter, forward, swaps, futures, options, CD, credit default swaps, interest rate swaps, currency swaps, and equity return swaps. Now, these are the types. You like my handwriting, you don't like it. Those are the top swaps. Those are the top derivatives that we're going to spend this semester playing with. Those are the players in the game. The players in the derivatives games are hedgers, like the farmer in our example, and the coffee shop owners. Those are hedgers. They want to hedge that one type of risk they may run into, the price risk. So they hedge and they enter a contract with each other. The speculators, me and Kevin has nothing to do with the coffee. We don't have a coffee shop, we don't buy coffee, but we want to went to the future market and we buy and sell futures. We don't have no interest in coffee. I'm only interested in dinero. So what we call us? Speculators. We don't have any risk. We don't have any business to do with coffee. We are, in this case, speculators. Arbitrageurs, those are the cheetah of the market. They find mispriced assets and they buy it and they take a position with what we call it riskless, not risky-free asset, riskless investment. They have to act very fast. The opportunity window open and close quickly, and there's a specific set of circumstance we can learn how to use some arbitrageurs techniques to take advantage. Now, I told you, remember, when an opportunity exists, some guys, I said, we need to get all the buyers and all the sellers together, and this is an exchange. I just want you to show you the size of the opportunity. Chicago Mercantile Group is one of the biggest in the derivatives market, and they have 23.3 million contract during the year. They are a public company. They made $5.57 billion in 2023 as an exchange, or almost $6 billion. Their total revenue in the fourth quarter was $1.4 billion. Their net income or earning, again, this is per quarter, and this is how much they make a year. Now, this is an example of how future contract look like on the exchange and CME contract unit. Each contract of the coffee consists of 37,500 pounds. If you want to buy a contract, that's one contract. You buy 2, 3, 4 contracts, you can buy a contract and a quarter, right? They don't come fractions. If you want to deliver, you have to deliver with US dollar. And we're going to dig deep in the price movement exchange. This is the future. This is the date when you can only the expiry date of each contract and what months and when does it expire. And I think you had enough today. Any questions? Don't run, don't finish yet. We're just warming up. Any question, guys? I need to take that 10 then. So we're not done.